Okay, my friends, if you are here, then that means you're interested in changing your trading behaviors. If you follow me on social media, you know that I have a way of trading that is trading on the side of the big money and the smart money, kind of staying away from these ideas of patterns that induce traders into believing it's going to do one thing when in actual fact it does the complete opposite. And so I want to be able to teach you guys that. So there's a lot to cover. I don't want to waffle on too much. I will try to explain things clearly, and I will cover things that I think you should know, as even though I think these sometimes may be basic, I think you should at least be able to have an handle on most of these things. So without further ado, let's get at it. Okay, well, first thing you want to be able to make sure you understand is how to access the most frequently used tools. These are what I would call my favorites, and they're my go-to. They're the things that I use most often when it comes to trading. Quite simply, to be able to do that, you just see in this left-hand pane here, if you hit the little arrow, you can see a number of these have got stars next to them. Don't worry, I'm not going to explain each of these now. We're just probably going to cover some of these at least on the training session anyway, and they'll become apparent. But I don't like fumbling around trying to figure out where certain things are. So each time you come across one, you just favorite it and it's nice and easy. The other thing that we're going to cover extensively is the object tree. This is how you up your charting skill set and keep things nice and clean. There is nothing worse than a chart that just looks too messy. Really puts you off and you lose a little bit of focus. So first things first, one of the things that is really important to understand is where most trader volume takes place, because when you start to see price consolidate, that normally means it's followed by a move in between the consolidated areas. We know that big money, large money likes to trade where liquidity is high, and the way to find out where liquidity is high, of course, is where volume is traded. It's usually where trapped traders get caught, and so what we want to anticipate is where are these areas going to be. The way to figure that out is you use a tool called Visible Range Volume Profile. Now, this might be, I think you need to have a paid version of TradingView to access this. However, there is a workaround, but I would still suggest if you are serious about trading, realistically, you should have a paid version of TradingView. It gives you so many benefits that this session is not really catered towards. However, trust me when I say it will pay you dividends if you get the right version. So I just get the standard version, the basic one, or Pro, I think it is. Now I also have a referral link. I think it's in my link tree on TikTok, believe it or not. So if you want to get some better benefits or whatever bonuses or whatever it is, feel free to use that. Okay, so volume. First things first, you can do it in two ways. The way I do it, this is a paid version, is just using the Visible Range Volume Profile. But the other way is you can actually just use this fixed range volume profile here, and you select this point here and just drag it all the way to there, and it will do pretty much the same thing. Okay, so you should be okay with that one. I don't use many indicators. In fact, I don't think I use any indicators to trade, if I'm honest. And I think every single trader should be able to execute these ideas without needing indicators. So what have we just put on the chart? We've just put on the Visible Range Volume Profile. This is the entire Bitcoin price history, and therefore what's important is we can identify in this chart exactly where the most traded volume is, and incidentally it is at 19,197. So that's where the most amount of volume is being traded across the entire Bitcoin chart. What we want to do is we want to map out all of the peaks within this. Now this red line here, what we're seeing is called the point of control. It represents, like I say, the most traded volume. But what we do with this Visible Range Volume Profile is we show 70% of the most traded volume. We look at the value area low, which is the lowest part of that 70%, and we have the value area high, which represents the highest part of that 70%. And these are psychological, let's say, support and resistance. You see these on the chart, they are like magnets to price. And so, your value area low, your point of control, and your value area high are always ones that you want to mark out on the chart. So that's pretty much what we're going to do. So the way I like to do it is I like to use the rectangle tool, and I just like to mark them off the chart. So let's just get going with that. We're going to start off with this here. I'll just ignore how this looks for the time being. What I'm actually trying to do is to just get the size correct. You can see each one of these bars. I'm only really interested in getting it at the same size as the bar, which is about there. Perfect. Now we can scale back out. And what I'm going to do is plot the peaks. So I want this to be you can choose whatever color you want, but I like mine to be the same color. So we'll just kind of that white, and I have it about 20%. Might have a little bit lower, go 15%. I don't want to see it really on the chart, I just want to know it's there. Okay, so let's get going. So where do we want our first one? We'll start from the top and work our way down. So I'd probably say that's the peak. What I'm looking at is this corner here to see where our price is. Next one down is there. Okay, so we've just drawn a load of lines on the chart. These are essentially just represented all of this volume profile here. We used the tool, and now I'm going to get rid of this here, and now we're just left with this beautiful looking line chart. So what you'll see here is all of the areas of high volume. These all represent the peaks. Some of them will be just standard peaks, some of them will be point of control, some will be the value area high and low, but equally they're all relatively the same thing. So I'm just going to create a group of drawings. I've gone into my object tree here, create a group of drawings, and I'm going to call this high volume zones. Okay, that's a nice piece of work done. Next, we're going to cover our key high term timeframes. These are very important. So let's just get rid of them. So now the beauty about the object tree is we can just lock those down so I can't accidentally move them lines around. Sometimes it's not more frustrating than doing some nice TA and accidentally moving something somewhere. So the eye basically hides or shows, and if you don't want it on, so this is the whole point of having a really good setup, that you can only show the stuff that's important at the time that you're doing some of your TA. Okay, let's move on to the next point. So now we're going to focus just on this little area here. It's the recent price action. Seems like a logical thing to do. I'm just going to use my zoom tool, and we'll just zoom into this area here. Okay, now we want to start with the daily, and what we're looking to do is look for the key points where we changed and reversed. Now I'm using my horizontal ray, and I want my magnet tool on. You should do the same too. What we're going to focus on is where we see a change. So you can see there's a red candle here, and a red candle here, and a red candle here. This green candle changed the direction, let's say, of the price, and so we mark that with a horizontal ray. Double clicking on that ray, I'm going to change it to line. I'm going to change it to my apex green color, and then I'm going to label that, change the text color, label it to daily because it's a key high term time frame, and then I'm going to click OK. Now what you're going to do is click template, and you're going to click save as. Now you can see I've got a lot of different templates for the stuff I use anyway, so I don't need to save it as it, but that will be a daily. Now what's the significance of these things? Let me just do a few more first before we talk about the significance. Okay, let me just delete that, that was a mistake. Can you spot where the next one would be? Well, it'd be here. This was the pointers which we reversed. I'm going to right click, select template, and then go down to daily. Here's the next one where we changed direction. So you're there. Notice that I'm doing the body and not the wick. Now I could do one here, but I'm very close to here, and so this one, because it's closer, invalidates that one. Same with this one here, it's too close to there. So for now I'm happy to have just 3 daily key high term time frames. Now you've got to say to yourself, well, what's the importance of these? Well, this is the point where its whole trading range for the entire day reversed and changed its direction, so there's significance psychologically or other at that area. Same with this area, and same with this area. So we mark them off because what we're looking to do and the way we like to trade is always on the reaction to a specific point, which I term area of value. And you'll hear me say area of value a lot. That's because I'm only interested in trading when it comes into an area of value, and we'll pick out exactly how we identify these as part of the course. Okay, next one, we want to go. So then we want to just, again, keep it nice and neat. And we create a group, we rename that daily. Nice. So we've now got our volume profiles, and we've got our daily key high term timeframes. Next, we want to plot our weekly. So we now select W in our price rate, in our time range, and we do the same again. Okay, so up here would be the first one, because you can see this is where we change direction. Now I have a template made, but it's the same way. You will just, I select weekly, I just have them as orange. Doesn't matter what color you use, just something that represents a different color. Just next one down, this is the point where we change direction from going down to up. So we make that a weekly. And we do this one here. It's still a fair decent enough. There's about 500 point gap between that and that, so I'm going to leave this one in. Let's say weekly again. Nice. And then finally we'll just do one down here for now. Now if price starts to move down here, I would start marking more of these zones out, but you don't want to be too complex or too, have too much data in your chart at once. You guys will know the drill now. So we just say create group, rename, weekly. Now I found over the years that the higher the time frame, the more significant the level. So a weekly level will be probably more respected than the daily level, and the monthly will be more respected than the weekly level and the daily level. So a nice segue brings us onto the monthly. Now you can see as you get higher with time frames, you have less. So significant change here. I'm right clicking template. I already have my monthly, which is a nice purple. Let me change again here. Template, monthly. We've also got one here in the middle. Nice. Perfect. I wouldn't do one here just because it's too close to that one, and this closer one acts as a better support or resistance than this one previously. So that looks okay for me. We could argue we could have one here. In fact, I'll probably just put one there just because of the distance in the range. That's 1,000 basis points there, yeah? So we'll keep that one in there. Okay. We're going to right click, create a group, right name, monthly. Perfect. So to recap, we're going to go back to our 15-minute. So far, you've done nothing complex, easy to follow, right? We've just plotted our volume ranges where price gets sticky. You can see we consolidate around these areas. Notice actually that price really powers through, but then congregates around these areas. So you're thinking about future predictions of where consolidation is likely to occur versus, a big move. So like, for example, this whole area here, take my magnet tool off, is what we call a contraction or a phase of consolidation. And the longer we stay in these phases, the higher likelihood that we're going to get a big breakout to the upside, usually with high volume depicted here. And so, for me, what I want to know is, look where the volume zone is here. So when we had this huge break to the upside, if you're on a, let's say you're on a long and you took this liquidity grab here as a long, and you're thinking, well, where do I get out? I'm going to ride it right up to the actual volume zone, and that would have been a perfect idea. And people don't teach you these things. It's not like you know where to go. We've used nothing. We've used no support, no resistance. All we've done up to now is just mapped out our volume range. Let's try and overlay that with some other key data and let's see what it does. Let's add in our daily levels. At these ranges, remember this isn't close to where we are, but at these ranges we have a nice volume zone here. Weekly, we have these there, and then on the monthly you can see we have a nice volume range there. So what this is all about and the way we trade, we're going to put these locks on again so we don't mix this about, is about confluence. It's about multiple ideas all coming to a specific area that creates value. Okay, now the next thing we want to do is create liquidity. We need to take a little pause here a second just while I explain what we're looking at here. So let me take this zone here, right? We'll analyze this. Let's just look. What we'll do is, if I rewind back, this is a paid for feature, by the way, this rewind here, and it's easy to rewind back, but what we want to do, right, is we want to create We want to understand where price is likely to go and where liquidity is likely to be. So this is relatively close to where price is today. As we're looking now, we've got maybe a day or two. But liquidity, what is liquidity? Liquidity is, it's food for the markets. Where price goes is where liquidity is going to be, because again, this point about being able to exchange prices without impact is a key one. It's a big idea. And so we'll often see market makers and liquidity providers try to get price into an area where there's going to be a lot of price traders. What do I mean by that? Well, you can imagine, can't you? If you take this area here, I'm just going to put my magnet tool back on because I want to be precise. You can see at this area here, this point, and I'm going to create a template, which I'll call liquidity. However, I want my liquidity to be white once it stands out. I'm actually going to save that as a template and overwrite that one. That was a mistake. Okay. Save as liquidity. And yes, I want to overwrite. Okay. So I've put this as liquidity. Why have I said that this is liquidity? Well, for a start, we know that for the price to return here, a large amount of money will have had to have been placed in order to be able to reverse price. I mean, the problem is when the price comes down this fast, there's be very low liquidity left here, which means that the price can actually move up quite quick again, because the price points as price moves back up. If there's low liquidity, it's much easier for those buys to push the price. So what that normally means is you get a lot of stop losses in this range. It's the local pivot low, so it's the lowest point where we've seen in the chart for a while. And so there'll be a lot of orders exchanged in this area. So price will eventually magnetize down here. So liquidity is important to just understand. The other thing that's key is where you see a lot of this. So we draw another line here, which we're going to call liquidity again. And you'll notice what I'm looking at is the peaks. Okay. So where else would be liquidity? Well, here would be liquidity because there's nothing above here from this price. So what you're seeing is price hasn't broken this zone because that's the recent low, or that's the recent low, and price hasn't broken this zone, but there's nothing behind here, or there's nothing above here. Where would be the next liquidity above, do you think? It's going to be here. It's going to be here. It's going to be here. And it's going to be, and it's going to be here. Okay. Now, we're just going to rename these liquidity. One of the problems though is when we do too many of these, it's understanding, well, which one might price go to? Because remember, price always wants to go where money is stuck on charts, resting liquidity, so where price can move up. And more often than not, what price will tend to do is go where the liquidity seems like it's starting to bunch up. Now, we may see, actually, price could quite easily say, well, actually, I'm going to come down. I'm going to take this liquidity, I'll take this liquidity, and then I'll come back up and then start to take this liquidity. And that, when you look behind this idea of patterns and triangles and flags and all this kind of nonsense, they're nothing more than inducement zones, areas in a chart induced for retail traders to come in, build patterns, and because they think these are the places where we're going to find the price will reverse from, or each time, and they'll get their entries. And sometimes it will happen, but each time it happens, all it does is two things. It reaffirms the idea to the trader that he thinks he's good, or she thinks he's good, and as a net result, they keep on doing the same thing. Buy when it hits the bottom, try to sell when it hits the top. But the problem is, if you keep doing that, you're going to find yourself like locked out. Like, for example, this is liquidity here. Forgetting the fact that we've had this push. What happens? Price comes up, hits these lows, hits the point here. Stop losses all get stopped out here. And those people who were in there have now been wrecked. And so this kind of idea of trading into ranges is not a good idea. Spotting where liquidity will rest is a good idea. Okay, so we've got our liquidity. Fantastic. We're now going to put these into a folder. Liquidity. Now on to my absolute favorite part. Now we want to draw inducement zones. Yeah. What are inducement zones? Inducement zones are where traders, poor traders, let's say, will put their entries to, put a trade in, right? So let's draw some out. I'm doing this by eye, right? And I'm looking for touch points. So let's see. That's not what I was after. So we want to draw out some zones, right? So let's get going. I would say that looks like zones. We have touch point, touch point, touch point. Okay. I would also say that we also have a nice trend line from here down there, which is not yet been tested. So touch point number 1, touch point number 2. Remember, 2 data points create a trend. More data points create an even stronger trend. Okay, so get off free play mode, it's annoying me. Get off that. Okay, now what about where would that go down here? You could argue actually that we have even more points there. 1, 2, 3, 4, 5, 6, 7. So we've got really strong trend there, okay? What about, do we have a trend here? Yep. See, that is a liquidity grab, yeah? This is where someone drew a trend, or drawn a trend, but actually the trend broke, and then a reversal occurred. So the whole thing about the way we want to trade is to catch these nice big areas on the chart where we get a nice order and a nice reversal. That's exactly what we're about. Okay, so we're following so far. Yeah. Just touch point. Oh, touch point. There you go. Perfect. Right. What else have we got? So I can see a nice range here. Do you agree? Yeah. But I can also see a range developing, I think, here. I may have that slightly wrong. Let me just see. I would like actually that to be there. Do we have anything that gives us a confirmation here on this touch point? Not really. So I would just do this here as the start of a new range. Sorry, that was a bit crappy. Okay, so we have a nice ascending triangle pattern building up here. Could see a breakout. And now what we want to do is just give these a different color because we don't want red. But what we do want to do is actually color these. No, in fact we won't. I won't mess it up. We'll keep these a nice orange color. Okay, now zooming in real quick here. You know, what we're looking for is, so we've had a couple of touch points here, which is nice. We've had number one, start of the trend, and a confirmation that it is in a trend at this point here. So you could say, actually, this whole area here would be a nice area to short from. Why? Because likelihoods is that if price comes up here, it's probably going to test this, may even break through. We would want to scale an entry as a short position, so we'd want that as a red box, not a, and we'd have the transparency about 20. Okay, so this for us signifies an area where we'd be really interested in taking an order. Of course, down here would signify a really interesting area where we would want to short from. Okay. Now, for me, I would probably look about, just as a test, 100 data points, maybe a bit more. If I look at the price, yeah, about that. Gives you enough on the move. If it goes beyond 100, it's probably an invalidating move. You don't really want to carry on with that, although it's still possible. But I would much rather, you know, just take a 100-point loss with relative risk management, 5%, 2%, whatever you are comfortable with in terms of your risk profile. That's 100 points. Let's see, price action to the top. 100 points there. Perfect. Okay. So what I'm doing with these is I'm going to recreate a channel and I'm going to call that inducement. Why do I call these inducements? Because these are the, I'm going to call these A of value okay. These would be my areas of value, areas where I would be interested in taking either a long or a short. Red would represent a short, green would represent a long. Now the problem is, if price does break through this and then we look at this next area here, well then that would be an area that I'd want to short from also. Don't know what that is, quite 100 points, but it's roughly about the size of that. That would be another area which I would just mark as red for now. The moment price goes above these zones, obviously your area of value would be beneath this inducement zone. So you've got the colors just represent the type of trade, whether it be a long or a short, and we're going to get into how we refine these a lot more as we go. So let's see how we go. Right, just as a test of where we are at this moment in time, we haven't even started yet, but and we've got our inducement, and then we've marked out our liquidity. Now we know we'd also say actually that we have, see, this would have been a liquidity line here, if you'll indulge me, because once price breaks here, we break back down. Price reversed at this point, so that was a significant point on the chart where we reversed. Of course, look what happens. Price comes up, breaks through the liquidity, hits this nicely, so we've now got a second data point, but price then comes back down. Now, if our entry above liquidity is here, because as well as areas of value on these trend lines, you also want your area of value to be represented on the actual liquidity line. Just let me get rid of the magnet. So you're also going to have a liquidity line there, which again would be red. Let's mark that as red. Okay. And you're going to have the same down below. You'd have it here as well. So you see here in this zone, you would have had a lovely entry. You'd have had this liquidity being taken out. You'd have had a reversal, and you'd have got absolutely perfectly on there. And then, of course, you'd have got your short or your long in here, just because we broke it very, very small, but we still broke it, and now price is heading back up. So this technique and this idea isn't about the line, it's about breaking the line. Now this line could go right down here, probably even further, to be honest, but the idea is that more often than not you're going to get a reversal. Now it's like, well, how many basis points do you want to take profit on? Well, that's up to you. 50 points, 100 points, 200 points, it's all to do with how you risk it then. But ultimately what you want to be able to do is get a really solid entry and a scaled entry at that. So it could be starting your scaled entry here and ending your scaled entry here. So if you was doing $100, you could have $10, $10, $10, $10, $10, right? You know, 10 times $10 entries scaled down here so that you're getting your fill. And if you only get 50% of that filled, well, that's fine. You know, you've got to think about that. How do most people trade? Well, then most people trade have their entry here and their stop losses here, or maybe here. The problem is, if price comes back down, it's this liquidity zone here, and then hits price back up again, stopped out and wrecked. You're not. You're only starting your area here. You might have your stop loss down here. You may already be accounting for the liquidity that might be sitting under here, because don't forget, you know, we have a buy liquidity here, don't we, too? Where we're interested in. You see? Hopefully the picture's starting to open up. So this could be an invalidated move, or you might say, well, actually, I only want to get interested in this play if we break here, and this play might not be one that I'm interested in, because don't forget, we've also got liquidity here. Okay, now I wouldn't class this as liquidity because we have a number of points all around this area. It's below here I'd be interested in. So you could argue that this could be your, you know, you'd have your stop loss of this just somewhere around here below this liquidity line, because this is where the liquidity is here. Next one is the liquidity's down here. So a lot of the times in lower volume we have a little spike, little liquidity grab, and then a reversal to the upside. You can see volatility's been quite low. So I'm going to move away from these. This was just an analysis. I wanted to just show you. Ooh. We do want our area of value, but we're not too bothered about showing these just yet. Okay, so let's just move our liquidity and our inducement. But you understand the reason why we're doing this inducement. What we want to know, we're not using the inducement for entries, we're using them to understand where others will have their entries. That's the key point. We want to understand where the majority of people will be putting their trades, their, you know, reversals, whatever it would be. Just one thing to remember on inducement. Remember, the key to this is liquidity. If I'm a breakout trader and price breaks this zone here, What do you think I'm doing as a breakout trader? I'm aping in because I think this is the breakout. This is the time when big money's going to move. But what happens? There's no more sell side liquidity. And now we are reversing because price snaps back. Big order comes in. Usually it's a wall of liquidity as passive orders, known as limit orders, are sitting in the order book. That is too much for the aggressors to fill, and then price will reverse back down. See it time and time again. I would never be a breakout trader because you don't know when the breakout's going to come. You've got an idea, but more importantly, you don't know when the breakout's going to end. Biggest thing that we do as humans is we are greedy. We don't know when to stop, really. That's the problem. So that's why for me, I'm a much better trader trading the reversal than I am trading the breakout. So that's always something I always like to keep in mind. Yeah, breakout traders will always try to get a big order. So on top of stop losses, on top of liquidation levels, you've also got your breakout traders who will throw liquidity down at these areas, build a massive amount of liquidity, and then price can reverse because there's a big exchange. Banks, institutions, they like to trade where liquidity is. Bang, reversal comes in. If we are trading like banks, then we're on this reversal, aren't we? So, okay. So now what we want to do, now that we're starting to build a bit of a pattern and understand things, we want to go to ranges. I'm going to talk a little bit about some concepts to do with smart money, understanding fair value gaps, because I think these are going to be important to understand where price is likely to go. So because a fair value gap, what is a fair value gap? Well, you see this wick here? And you see this wick here? Well, there's a gap in this candle. I'm going to draw it so you can see it really clearly. The gap is from here. If it was just, in fact, let me just take that off and that off. If it was just this candle, I'm going to zoom right in. I'm going to colour that white. You can see the candle there to the wick there. That's the gap. The gap between the wicks on either side. A fair value gap is constructed of 3 candles. Now what's happened in this next candle is we've closed the gap to there. So now the delta or the gap on this fair value gap is now decreased. So we don't like to see gaps in the market. It's inefficient. The inefficiencies, it's where there's been a huge imbalance between buyers and sellers, and the market always likes to come back and fill those gaps. So right now we've got a daily fair value gap on a daily time frame. So this is a problem. So we want to try to fill this, or markets will always try to fill it. Maybe not today, maybe not tomorrow, but at some point we will come back and fill this gap. But what we want to do is we want to understand on a lower time frame where the actual gaps lie. Okay, so let's go to a 12-hour. Same gap. Let's go to a 4-hour. Same gap. 2-hour. Same gap. Nothing's broke it yet. And you can see, by the way, here, if I just go back to the daily, when this candle came in here, the fair value gap was here to the bottom, right? And then this candle came in, got closed, but we still had a fair value gap. Next candle, nothing. Next candle, nothing. Next candle, nothing, nothing, nothing. Oh, this candle closes our gap to here, between there and between there. Next candle, closes our gap even further. And then finally, this candle closes the gap entirely, okay? So you can see the gap's got closed. It doesn't have to be the next candle, but it's always going to try to close it. So now we've got a gap to the upside, okay? So now it's about how can we close this? But for traders, we want to try and get that's too big of a gap to figure out where an entry would be, where price might reverse. Okay, so it's like, okay, well, this is why we just keep on figuring out where the best gap will be. So we've gone to daily, we went down to the 2 hour, I believe, wasn't it? Yeah. What about the 1 hour? Okay, still got a gap. 30 minutes. Okay. Now we have two gaps, okay? So we have a gap here. And we have a gap here, yeah? So now what this means is we have an opportunity for this gap to get closed, and this gap can remain open because at least there's been an attempt, and maybe we come back and close this gap in a different trading session. But let's continue. Go 15 minutes. We can still see it hasn't really changed. 5 minutes. Let's see. Yep. That's now there. That's closed that gap there. So now we are here. So actually this gap is bigger because we've closed the gap to the upside and back down. So now actually the original gap is actually a bit less now. Yeah. And this is how we figured out the actual gap. Okay, down to the 3. Let's just expand this out. Okay. This one here, this one there. Gap's getting a little bit smaller. We have not, and we haven't opened that one because that one's there, and then there'll be one up here. Let's just do the 1 minute to close this out completely. Just run it back. Let's see how many gaps we have. Okay, so this gap can now get closed to here. Again, what I'm interested in is the wick of this one and then the wick of the one after. But actually, this wick here has rendered this one a little bit smaller again, which is good. Okay, so I can go there because now this wick has closed it a little tiny bit more. But then we have some smaller ones above here too, so we can say, well, actually, there's one there. Just want that to extend right. Then we have one here. Okay, and then lastly, we have one there. Perfect. So that's there are true fair value gaps. So if you remember, we started on the daily. So So what looks like one huge big fair value gap is actually comprises of a number of fair value gaps. Now these are going to be prices on the chart where, you know, we're going to want to at some point come and collect. Now the question is, well, which one of those would be the most important? Like if I'm trading on a macro level, if I'm a swing trader, how do I evaluate which one of these will be the most important, or at least which ones will be the most important? And this is where this idea of value comes into play. And the way we do it is we have to identify from where the price is now, what would be classed as the premium zone and what would be classed as a discount zone. So if you bought Bitcoin at this price, would it be cheap relative to its high point, or would it be dear? And this is where we use our fib retracement. So again, you want the magnitude. Now I'm on the daily time frame, and I'm going to the lowest point. And if we are below, that's classed as a discount, and if we are above, it's classed as premium. Okay, so right now, as I see things, this is equilibrium. If you buy Bitcoin at this price, it's relatively fair value. If you buy it below, you're buying it at a discount. If you buy it above, you're buying it at a premium. So you can almost anticipate that we're going to come up and take these out just as a retest. And in terms of where the most liquidity is, well, that's exactly what we want to identify. So if we go down to the 15-minute, do we have any alignment? Let's see what our daily levels. Okay. Well, first thing that's sticking out is we have a nice daily level at that 23,129. Right underneath, we have our fair value gap. But I would suggest that we'd want to go with the one above, because remember, where does liquidity like to go? It likes to be above. You know, if we are going to go short, then we want to catch liquidity at this zone here. So whilst I expect we'll get a reaction in this zone, and while I expect we get a reaction in this zone, I would anticipate this would be a more valuable area in terms of where I would be wanting to short from. Okay, as a macro trader, as a swing trader, not so much as a day trader, let's just say. What about daily level, weekly levels? Weekly levels don't really provide anything significant for the zones that we're contemplating. What about monthly? Okay, so we have a monthly and a daily level right at this zone. So now I'm thinking in my head, okay, so we are in a discount area, so price is relatively cheap in terms of where, you know, above the equilibrium. So that means people are more inclined to want to buy at this underneath here than above here. Now remember, the way to set this up is if I double click, this is what we call a Fibonacci retracement tool. And it looks really complex when you first see it, but it's not really complex. It's just a series of numbers based upon nature. And the sequence is very straightforward. It's just simply a ratio of, if I say 1 plus 1 equals 2, I then say, well, 1 plus 2 equals 3, 2 plus 3 equals 5, 3 plus 5 equals 8, 5 plus 8 equals so on and so forth. So you're taking the answer and adding the previous addition to it. So each time, and the ratio of that provides these kind of numbers, this golden ratio number, or the ratio of numbers between the addition of the previous number and the answer. So these kind of 0.236, 0.382, 0.618, 0.65 actually isn't a ratio of the number, 786, and then 1.618, 3.618, so on and so forth. So the key numbers just for this is you really only want the 1-to-1, which is the 1 here, a 0.5, and obviously the 0. Now the 0 point is for me the point of discount, the 1 is the point of premium, and the 0.5 is the equilibrium, the point at which price is at the fair value, let's just say. And you can colour these any colour you want. I have one at my premium at red, I have my discount at green, and I have my fair value at 0, or equilibrium at white. Okay, so high point, low point, anywhere in between gives us the idea of the cost of Bitcoin. So as I say, what I'm trying to favour is, do we have zones where price is cheap? Really, I would have liked to have seen a price, the higher you go for fair value gaps, the better the reversal potential is, because Bitcoin is still cheap down this end, remember, in comparison to where we've been between a high and low. So there's every chance that this might not be the zone in which we ultimately reverse. This might not be the zone where we reverse, so on and so forth. The higher you go, the higher the likelihood, just because of the value of the Bitcoin, let's just say. So just all about confluence. It's about these ideas of things coming together. What happens if we map our zones with liquidity? It gets a little bit messy, but this is the power of having the ability. I mean, look, if you have all of that just looks horrible, doesn't it? So this is why we want to be able to select these things, more of these rectangles here. These are our fair value gaps. So let's add these in. Create a new group of drawings. Rename. Fair value gaps. Okay. So let's get rid of, let's call this rename. Just our fair value fib. Okay. So we have our fair value fib, we have our fair value gaps, we have our inducement zones, we have our liquidity, we have our 3 high key high term timeframes, and we have our volume zones. So now looking at all of this together, we're being able to paint a framework of where is price likely to go. So let's start with what we drew first. We drew our volume zones. We have a volume zone here, we have a volume zone down here. So price is probably more likely to come up to this zone before going to this zone, just because it's closer. We overlay dailies, weeklies, don't really provide anything yet. Monthly, yeah. Liquidity, okay. Inducement, I'll take that off. Fair value gaps, whoa, okay. So now we have a monthly, a daily, a fair value gap, and a liquidity zone. Sorry, a high volume zone, right? All in this area here. So what I would do now is I would say this would be my biggest area of reversal, okay? And I'm going to colour this red because price is currently below it, which means I'm really keen. I would be really favouring a move to the downside if we come to this area, just because we've got so much confluence in this area, so many things coming together that have provided us with a pretty strong case for a retest, and therefore something I would be keen. So how do we validate this in terms of just where this would be on the chart? So if I take my Fibonacci retracement out, I can go again, local high to the local low, but this time I don't want to use my fair value fib. I want my fib retracement. And what this gives us is the ability to look at the Fibonacci numbers, right? Now the Fibonacci numbers, so this is your 0 point, this is the point at which you essentially going from, this is your low point, and this is your high point, so you're 0 to 1, and then every ratio in between, that's a Fibonacci number. So the first one we have is the 0.236. Second one we have is the 0.382. The 0.5 isn't a Fibonacci number, it's actually a number, it's just a midway point, and we just like to put them on a chart. This is what we call the golden pocket. Again, 618 is a Fibonacci number. 0.65 is not a Fibonacci number, but this is a golden pocket. It's the place where more often than not we reverse from after a significant move to the downside. Okay, then we have the 786, and then finally the 1-to-1. And so what this is starting to do now is just provide more confluence in this zone as a reason to want to use this area specifically. But remember, for me, it's not, I'm using this, but again, how many people have this same idea? Let's just say 1, 2, many, millions. And so you've got to be careful, and always remember about inducement. Always remember that these things like Fibonacci's, zones, they're all there to guide you as a trader. I'll tell you what I will do. I'll leave that on because I just want that to be off. And I want this to go into a drawing that I'm going to call. Because area of value for me is really where I'm placing my trade. AOVs, right? So that's my trading zone. That's where I would happily short the arse off this. Okay, too much confluence in this area for me not to. This is what I would call a hugely high probability setup, and whilst I will allow the traders to trade the way up here, and not too much bothered about getting involved, I could find once price comes up to here, a short would be very, very interesting to me. And then what you could probably find will do is, and this is how you make money all the way up as well, is, again, just bring up my liquidity. Each time price comes up, crashes liquidity here, price comes back down. All you do is you simply add a new liquidity line here as the new liquidity. And again, you point your short here. Price comes back up, makes a new high, comes back down, and this is essentially what a trend line is, right? It's just a trend. Yeah, so then you've got your new liquidity line, and then price comes back up one more time, gets into our area of value, and then of course, what do we have on the way down? Liquidity. It's a little bit high. Yeah, liquidity, and it's the same. That's all we're doing. We're hunting liquidity. Yeah, finding out where the low point is on the chart, waiting for price to come to that area. Boom, we get an order. We long or we short. I just like to pick the main zone where I think eventually price is going to, and know that I've got a larger order here. Here I'm into kind of small scalping in and scalping out moves on the way up, hitting the point that I think will reverse from for another huge move to the downside. And it's just time and time again you're going for these zones. Now the other key thing that we need to just understand as well is order blocks. Now order blocks, again, will start high. I always like to start on the big areas. Now an order block is where significant price, we've had a significant change in price. So as an example, right, you can see here, I believe this is an untapped order block. Yes, it is. This, we came down here, price reversed back, and then this area here became the area where we reversed from, significantly so. So you can see price has come up, come down, and then started to come back up again. So you would have drew this as an order block. This whole zone here was an order block, and you can see how many times we come and hit the order block before price comes back up and goes again. So this whole area, when I say order block, it's the point at which significant money, so prices come up, price tries to come back down, price come back up again, had a little retest. So order blocks are areas where you can expect another order to come in and price to go the opposite way. I mean, this was mitigated, so this means each time we come into this order block area, essentially it weakens the order block. So let's find another one. This would have been an order block. So you can see this candle became point at which we reversed, so it came down. So we're covering the whole of that candle. Of course, what happens, we come into the order block, come back up, price goes to the upside. Of course, order blocks don't always stay order blocks forever. They get mitigated the moment it's mitigated, i.e. we invalidate it here, then it's invalidated. We remove that order block, it's no longer in play. Okay, so price comes down. Where's the next order block? Here. Okay, so price comes to a low point, comes back down, hits the low. So now where's the next point at which we test the order block? We test it here. This would have been a perfect entry. Of course, price just absolutely shoots to the upside. Here's another order block at the top. This is a sell side order block, so you can see here, price comes in, this candle here gets reversed to the downside. Of course, we come back, test it once, test it twice, each one of these providing a lovely move to the downside. Order blocks where you've got a significant reversal. There's different ways in which people draw order blocks. I like to cover the wicks, more safer than covering the bodies, because you can cover the body of a whole order block. For me, I like to cover the wick because, you know, I mean, you could argue actually if we did cover the body here that this one would have been a valid entry as a sell, but for me, I think a better move would have been getting this one and getting this one. This one would have printed a lovely move to the downside. We come back up, test it again, test it a fourth time, actually fifth time on this one, and then price moves back down. Of course, we have another order block in this zone here. Problem is with this order block, it didn't really get tested. This is the point at which we create the order block because it's the lows. You can see how many times we kind of bounced off this. Did get a move to the upside. This red candle would have been, or the green candle here rather, would have been the order block. The problem is I would have had my order block here. This would have invalid. Well, actually, no, I would have had it here to the red, so this would have invalidated that order block. So this wasn't a successful order block. Next order block we see is this one here. Again, nice test on the second one, nice test on the third one. Beautiful move to the downside, perfect order block, entry to the downside. So order blocks, fair value gaps, liquidity zones, mapping these out. These are all fantastic ways in which, you know, you can look at areas on the chart and just give yourself a better chance at getting an entry. Instead of this idea of, let's just say, no, I'll probably just to finish these off, by the way, we'll call these order blocks. Okay. Now order blocks right now, I'm on the 4 hour. These work on different time zones. So for example, let's say we focused and targeted on this. We want to target on this one here, right? So this is the 1st of March. So we're going to go to the 2 hour and zoom into the 15 minute. Let's see the point at which we hit that. Okay, so a refinement is there. That gives you an even better entry again, yeah, because we've shortened the order block because we've covered top of the zone here down to the bottom, top being the wick, bottom being the next candle. We could just cover the wicks, like I said on the previous one. This would have been your test zone. It's got a lovely move there. Didn't come back up and test that order block once more. So again, you start with your higher order blocks to give you, you know, an area. This would have been another order block at this point. So again, you'd have had this one, but you would have invalidated that. Let's see where the last order block was. Will it actually, yeah, might have been from further along here. But a new order block is created when we have a move to the downside. So that would have been an order block that had been invalidated here, but this would have been a new order block created, and then you'd have got that re-entry there. Perfect move to the downside. So again, using the higher time frames to start off where the order block is, but then the smaller, shorter time frames to get a better entry to reduce the size of your order block area is more significant. So, okay, let's put it all together. So we have order block here. Actually, well, now we've zoomed out a little bit. Let's just refine our order block at the bottom side. Where is the actual order block? Well, here is our order block. So that's that one. That hasn't been tested. Ooh, that's our order block there. And we have an order block to the upside, which is here. That is yet to be tested. Okay, so guys, we have order blocks. This is where price is right now, BTC. We have our fib. Okay. Don't need that right now. We have our fair value gaps. They are not in the zone. We have our inducements. They're not really relevant right now. And we have our liquidity right in these zones. So, you know, this would be a nice targeted area. Again, we've got confluence. Have a monthly there. Have the weeklies. And we have the dailies. Volume zones. Area of value. We have another area of value. Sorry guys. Yeah. Up here. Why? It's an order block, and there's a zone of liquidity, resting liquidity here. So there are two areas of values. I will have that in area of value there. These are area of values to the short side, but obviously we also have areas of value to the downside as well. So guys, I hope you've learned a lot on this. This will always take practice. However, it's, you know, a way in which you create a framework. Doesn't matter where you are on the chart, doesn't matter what chart you're dealing with. If you come to a chart, the first thing you want to do is step number one, you want to know where your volume is. Step number two, you want to create daily, weekly and monthly key high term timeframes. Step number three, we want to identify inducement. These are just patterns with the eyes, support and resistance, diagonals, flags, all the kind of silly stuff that retailers do. That just gives us an idea of where price is likely to go to. Then we want to spot our fair value, any fair value gaps within the zones. Remember, starting with higher term timeframes and then bringing them down to smaller term timeframes to see if we can reduce the amount of fair value gaps on smaller timeframes. And then, of course, we want to look at the fair value fib, so we know where price is cheap and price is dear. When you're picking out the top range and the bottom range of your local high and your local low, depending on how far back you go on a time frame, will determine a high and low price. Identifying where your equilibrium is. Of course, then using all the different techniques to identify your what you call an area of value. Just before that, of course, you want to identify your order blocks. So whereabouts on the chart are your order blocks. We know how often they get responded as well too. And then putting your area of values on the chart. The areas on the chart where you're really confident of a high probability setup. And I promise you, the more and more you do this, the more and more you work at it, the more and more you will sharpen your skills. And you'll get a real feel for it, almost like second nature. And a lot of the time, Honestly, I'm not drawing out liquidity lines and stuff like that, just because I can look at a chart and I'm to the point where I just know there's going to be liquidity here. I know there's going to be liquidity here. I know there's going to be liquidity here. I know there's going to be liquidity up here. I know there's a big fair value gap in between here. I know there's going to be an order block here, an order block there, and an order block somewhere above here on the lower time frames. And so I like to map them out sometimes, you know, if it's not clear, if I want to sharpen up an entry. But I'm only ever looking for reversal zones. So yeah, thanks for watching. I hope you enjoyed it. Obviously, you guys will have access to the Discord server. Any questions, please feel free to come in and give me a shout. Speak to you soon.